Investors, hello! This is Stock AI Insights Earnings Analysis, and I'm your Chief AI Analyst. Just a quick reminder, this is for educational reference only. It's not investment advice. Investing, as you know, always involves risk. Okay, let's get into it. We're parsing Lululemon's Q3 earnings, which were released on December 11th, 2025. And right off the bat, we got a huge piece of news about the CEO.
Yep. The company kicked off its earnings announcement with a total bombshell. CEO Calvin McDonald is stepping down. That's a massive leadership shakeup, and it's happening at a really critical time for the company.
But honestly, the leadership change is just the headline. The real story, the one we need to dig into, is in the numbers, and they paint a picture of a company that's really at a crossroads. So let's dive in.
Okay, so here's our plan. We're going to look at revenue and that geographic split, then dive into why profits are getting squeezed. We'll check out their cautious outlook, break down their new action plan, and finally wrap it up with the key risks ahead.
First things first, let's talk about the top line, the revenue. And this is where you can really see the company's, split personality.
So on the surface, things look pretty solid. Net revenue hit $2.6 billion, which is up a respectable 7% from last year. Looks good, right? Well, hold on a second.
Because look at this chart. This tells the real story. That growth is being driven entirely by their international business, which just exploded by 33%. But at the same time, their biggest market, the Americas, actually shrank by 2%. And that right there, that is the central challenge Lululemon is facing.
Okay, so with that weakness at home, let's move on to profitability and see exactly how it's squeezing their bottom line.
Oof, the gross margin took a pretty big hit, falling by 290 basis points down to 55.6%. I mean, that's a serious drop in how much profit they make on every single thing they sell.
And it gets worse. The operating margin saw an even bigger squeeze. It tumbled 350 basis points, landing at just 17%. And all of that, it trickles right down to the earnings per share. It landed at $2.59, which is a big drop from $2.87 this time last year.
So, what's causing this big squeeze? What's really hitting those margins so hard?
Well, management was pretty clear on this one. They pointed directly at new U.S. tariffs. They figure it's going to carve out a massive $210 million from their operating income for the whole year. That is a huge headwind to fight against.
So, with all these challenges, the tariffs, the slowdown at home, it's really no surprise that the company's forecast for the all-important holiday season is, pretty cautious.
Now, look at this table. What's really telling here is the guidance for Q4 revenue. They're actually expecting it to decline compared to last year. That is a huge signal that they think the slowdown in the U.S. is going to keep biting hard.
Okay, so the situation is clear. Now the big question is, what's the plan? What are they going to do about it? Well, management laid out a three-pillar strategy that they think will reignite the business. And let's spend a minute on this because everything depends on the execution here.
The whole plan really boils down to three simple ideas: make better stuff faster, get people excited about it, and just run the whole company more efficiently. First up, product. This isn't just about new colors. It's a total overhaul. They want to cut their development time almost in half, from around 2 years down to just over 1. The big idea is to react to what's actually selling in just weeks, not months. It's a shift from trying to predict trends to just responding to them really, really fast.
Pillar number 2 is all about activation. This means making a better connection with you, the customer. Think stores that are tailored to local tastes, a brand new website that tells a better story, and new perks for their most loyal members. It's really about creating that hype again and making shopping feel like an experience.
And finally, Pillar 3 is all about efficiency. To protect those margins, they're going to get lean. This means smart price increases on some items, squeezing every penny out of the supply chain, and a big push to cut costs across the entire company. Every dollar saved here helps fight back against those tariffs.
So that's the plan. It sounds pretty good on paper, right? But the road ahead is definitely not going to be a smooth ride. There are some major risks to keep in mind.
So if you're watching this company, you've really got to keep 4 things on your radar. First, that CEO transition. Second, the health of that core U.S. consumer. Third, can they actually pull off this ambitious plan? And fourth, of course, are those big economic headwinds, like the tariffs that just won't go away.
Verdict:
Lululemon's Q3 results reveal a stark divergence, with that booming international growth masking some significant margin pressure and a really concerning slowdown in its core Americas market, all happening under the shadow of a major leadership transition. So what do you think? Share your thoughts in the comments. I'll see you next time.